It's payday. Your phone buzzes, and there it is, a fresh salary credit. It is tempting to picture that 50,000 rupees sitting quietly in a digital vault somewhere, waiting patiently for you to scan a QR code at the local grocery store. The truth is, the moment that money lands, it leaves. It gets pulled straight into a massive, hyperactive recycling machine that we call the entire global financial system. The rules for how your money moves through this machine are written by a single traffic cop, the Reserve Bank of India, or RBI. The RBI sets the speed limit for the country using one specific tool, the interest rate. Look at the style representing the flow of money into the economy. If the RBI lowers the interest rate, borrowing becomes incredibly cheap. Businesses take out huge loans to build factories and hire workers, flooding the economy with cash. But if prices rise too fast, they turn the dial up. Loans become expensive, borrowing stops, and the economy cools off to fight inflation. Every bank, investor, and corporation in the system operates completely around the flow and speed limits set by this central authority. So let's track where your original $50,000 actually goes. It immediately splinters off into a few different directions. The bulk of it sits in a commercial bank. Banks are the ultimate matchmakers. They take surplus cash from everyday savers and hand it over to people who need capital to buy a house or expand a business. Consider massive institutions like the State Bank of India. When you deposit your money here, they do not lock it in a safe. They lend it out. Your deposit gets loaned to a local bakery to buy new ovens. That bakery pays its workers, who then deposit their wages right back into the bank to be loaned out all over again. Your savings physically expand the local economy. Then we have the money that disappeared before your paycheck even cleared. These are the mandatory deductions for your Provident Fund, or your monthly life insurance premiums. Those deductions flow to giant institutions like the Life Insurance Corporation of India. They collect small premiums from millions of people and hold that cash for decades to manage risk and retirement. Because they sit on trillions of rupees for such long periods, they are the ideal funders for slow, massive government projects. They provide the capital to pour concrete for new expressways and lay tracks for bullet trains. Your basic savings account and your insurance policy are the baseline engines transforming static wealth into physical infrastructure and local business momentum. Then we have the third pathway, your voluntary investments, like an automatic monthly SIP. If you only have 2,000 rupees a month to invest, trying to buy individual shares in 100 different companies to keep your risk low is a logistical nightmare. This animation shows how a mutual fund solves that exact problem. It takes thousands of tiny contributions from retail investors and pools them together into a massive fund. This allows you to buy a professionally managed basket, like an investment tally, filled with tiny slices of many different companies. By pooling your money with everyone else's, you suddenly have the buying power to own a fraction of the largest and most profitable corporations in the country. When you buy those mutual fund shares, you hold a literal piece of real physical operations, like a Tata Steel factory. Mutual funds bypass the exclusivity of the stock market, giving the middle class a direct mechanism to profit as the entire country's economy grows. Now we reach the high-stakes end of the system, located in financial hubs like Dalal Street. This is the domain of investment banks. Unlike the bank where you keep your savings, these institutions do not take deposits. They act as highly paid matchmakers for corporate mega deals. Their primary function is taking private companies public through an IPO. They calculate the value, generate the hype, and sell the shares to raise thousands of crores in a single day. Further down the risk spectrum is venture capital. These firms throw millions of dollars at early-stage tech startups, fully aware that most of those companies will collapse. Watch this grid representing 100 startup investments to see how venture capital works. Venture capitalists expect 90 out of 100 investments to completely fail. They accept those losses because the one golden winner will grow so exponentially, returning perhaps 2,000 times the initial investment, that it pays for every failure and still generates a massive profit. That exact mathematical model built household tech giants like Flipkart. They exist because a venture capital firm took an enormous early risk. The billions these VIP dealmakers and venture capitalists gamble with are often bankrolled by the massive pools of capital collected by the pension funds and insurance companies we looked at earlier. Let's zoom back out to that initial 50,000 rupee paycheck that hit your phone. Your life insurance deduction is pouring concrete for a highway. Your mutual fund SIP is smelting steel at Tata. Your bank deposit is buying flour for the neighborhood bakery. And your Provident Fund is backing the venture capitalists funding the next tech unicorn. This map shows the true scale of that network. From the Reserve Bank to a local startup, your money is in constant motion. This global financial machine relies entirely on everyday savings. The bankers are simply directing the traffic. Since your money is out there right now, working relentlessly to build the world around you, learning how this whole system functions is the best way to ensure that wealth works just as hard for you.